I want to talk today about filing status. It's not really a sexy planning topic, but in this case, for one particular area of taxes, it can be a really great idea to take a look at, especially for our clients. And the topic I want to talk about is married filing jointly versus married filing separately. And what I like to tell clients is that 98% of the time, married filing joint is probably the way to go. And that's because there's tax brackets that will phase out more quickly. There's deduction limitations. There's a lot of detriments to filing married filing separately generally. But there is one specific item, where we will go to married filing separate to help save clients, in some cases, tens of thousands of dollars. And this is a specific scenario that works the best for our clients there in California. And you might say, well, why California? California is one of the states that we would consider a community property state. And what that means is, from a tax perspective, if you file married filing separately in California, you're required to split the marital income exactly evenly between the two separate returns, which sounds kind of weird because you have a situation where one spouse is, the sole earner of the couple, but the tax filing would require both spouses to report 50% of the income on each of their returns. And so, a little bit, interesting, but that's the way things work in California. Because of that, for federal tax purposes, we'll often end up with exactly the same answer with married filing separate versus married filing joint. And so that kind of sets the table for us to look at, okay, well, what does this mean from a state tax perspective? And the reason we'll often consider, or sometimes I should say, sometimes consider married filing separately for our California clients is especially if they make over $1 million during the year. And, obviously that doesn't happen for everybody every year. But, with a lot of our clients receiving a lot of their compensation via equity compensation, if you have a big IPO event or big tender offer, something like that during the year, it's not unusual for our clients to have over $1 million of total compensation for the year. And this is where that tax savings comes into play, is California has a specific tax that applies to clients with over $1 million in equity compensation. It's a mental health services tax. It's an additional 1% tax on top of the regular income tax structure. And it applies for clients, where they're exceeding $1 million of taxable income for the year. And so, all of that, sounds like, well, that's kind of a pain in the butt. Hey, it's an extra 1% tax on top of everything else. How does this tie into tax savings? The key here is that, whenever they wrote the rules, for whatever reason, you get a $1 million exemption for both spouses, even if you file separately. And so if you file a joint return and let's say you make $2 million, that additional 1 million is going to be subject to the tax. But if you file that same couple as married filing separate within California, each partner gets the $1 million exclusion. And so, since income is required to be split evenly between the two spouses, we can turn what is normally a $1 million exclusion into a $2 million exclusion. And that's huge. Even though it's a 1% tax, we're talking a fairly good tax saving strategy for clients that they may not be aware of. And so, if you're filing your return this year, you had a big IPO tender offer event, something to consider. It's something that your TurboTax software may not pick up on. It's a little bit in the weeds, but it's certainly a very valid tax strategy. We've used it with a number of our clients. It's one of those things that unless you run into it and you're aware of it, it's very easy to miss it. And so, if you've been in this situation for this year and you'd like some help out with that filing status, feel free to reach out to us. Unfortunately, if this is a prior year issue for you, you can't go back and amend your return to do married filing separate. That's one of the unfortunate things with the tax law. The IRS says once you file jointly, you can't become separate after that. So it is an election that you need to make on the originally filed tax return. But if you need some help with that, feel free to reach out. My name is John at McCarthy Tax, and happy to help out and talk with you further about this. All right, thanks.